Your Lending Era, the podcast where we dive into the world of residential, business and commercial finance, bringing you expert insight, tips and strategies to help you navigate the intricate landscape of lending in Australia. I'm one of your hosts, Jessica, and in today's episode, we will be running through a few specific requirements for our self-employed clients and individuals out there. Here with me today, we have Trilogy Funding's Managing Director, David Thomas.
Hey Jess, how are you?
Hey Dave, I'm good. And we have financial strategist, Hope Westbury.
Hey Jess.
Hey guys, how are we doing today?
Doing
Excellent.
good.
Ready?
Recharged, ready to go?
One of my favourite topics today.
Yeah, well, you do a lot of self-employed business, don't you?
Yeah, so I'm looking forward to this one.
Okay, cool. Now, look, we all know that the banks change their credit requirements somewhat regularly. And over the last few years, no segment of individual borrowers has been impacted more than the self-employed client, have they?
No, look, they really have poor old self-employed people. They really have kind of been put through the ringer over the last 5 years, just tightening credit restrictions, but also what's been happening to self-employed people in terms of they've had to deal with COVID, then they had to deal with COVID grants, and then they had to deal with, has their business bounced back?
Yeah.
So lenders are, really quite touchy on self-employed people, and they're really drilling down into the requirements that self-employed people need to provide in order to get a loan approved.
Yeah, and even before COVID, like we were talking only a few episodes ago, before COVID it was kind of the Royal Commission cracked down on them. Before that it was APRA and ASIC cracking down on them. Like, it's an ever-going
Double
thing for them.
whammy.
Double whammy. A lot of my clients go, David, do we need a DNA sample? Will this get the loan over the line? Because they feel like they've had to give just so much information.
Just straight interrogation.
Yeah, 100%. And even, no matter how much work we do in the front end, unfortunately, even once we get an application to the bank, they can still ask for more.
Yeah.
Absolutely. Because self-employed is a case-by-case basis. No two businesses are really identical.
No.
Okay, so even if they're in the same industry, in the same town, there's going to be changes between those two businesses, how they work and operate, number of partners, blah, blah, blah.
Yeah.
And that's why banks ask for so much, because they really want to know and understand the income flows of that business in order to be comfortable in lending them money.
Absolutely. And let's kind of kick off here. So I know the traditional version of, a self-employed individual. We all know what that is. But let's talk a little bit more about really what being self-employed encompasses for a lender in 2023.
So what lenders classify as self-employed nowadays is pretty much if you're not PAYG and not getting a payslip, you're pretty much self-employed.
Yeah.
Okay. So if you are a small business owner and you are trading either as a proprietary limited company that you are the director of, you're self-employed. If you are a sole trader and you have your own ABN, you're self-employed. If you're a partnership with someone else and we have an ABN, we're self-employed.
Yeah.
If we are, an individual that works for a family business that gets our income through, profit distributions or something like that, we're self-employed. And if we are someone who works for another business that is a shareholder, then we are also self-employed. Furthermore, we can be PAYG with a side hustle. Every second podcast talks about side hustles and how to make money. If you've got a side hustle and you have an ABN number and you're registered for GST, you're also self-employed.
A lot of people don't know that too. It's not common knowledge that a side hustle could classify you as that.
Yeah, correct. And even if you are what's regarded as a sophisticated investor, so sometimes someone with more than 4 investment properties with some lenders, you're self-employed.
Yeah, because you're a professional investor at that point.
Professional investor. So you've got the majority of your income comes from investments rather than PAYG income.
Yeah. And even some of those, I know, for example, the family employment, that's one that is, a lot of people don't really enjoy that when we have to tell them that, because they've been working for, their Uncle Harry for the last 15 years. And like, well, why is this self-employment now? It wasn't 5 years ago.
Yeah, correct. And they look at it as though, they're not part of that business. It's just the fact that they get caught up in the fact that their name's Harry Jones and they work for Jones Family Plumbing.
Yeah.
That the lender goes, oh, hang on. This guy's self-employed. He's earning money from a family business. We want to have a good look at this.
Yeah, and it is fair to say that self-employed individuals, like all of those that we've just encapsulated, they're all assessed with a fair degree of scrutiny over, someone like ourselves, for example, who earn just a base wage or, other income types. And why is that?
I think it's just because when you're self-employed, there's, as Dave said, far more of a story to tell. So for PAYG applicants, we hand over a couple of pay slips to the bank, and there's a line item there that generally says what that person's base salary is, and the assessor at the bank looks at that, ticks it off and goes, happy days, that person's on 90,000. When it's a sole trader, when it's a partnership, when it's a company or a trust, obviously that opens up a completely different can of worms, and there's just so much more that we need to supply to verify that person's income. And that's why it's scrutinised a lot harder than someone that is PAYG.
Yeah, exactly. And I think jumping back a little bit towards the verification as well, it's interesting to note as well that the banks do generally have different credit departments that look at these things. So you've got like a PAYG section and a self-employed section. And the self-employed individuals are almost like mini accountants, I find, because they know exactly what to look for. And even if it's something that, we've seen and we're like, okay, that makes sense, they're still going to question it, even if we let them know. Like they might want something else to confirm what we have reasonably discussed. Yeah,
correct. And also the banks are looking at this higher degree of scrutiny, like Hope said, because if you look at percentage-wise, if you've got a PAYG person, the likelihood of that person going broke, entering into bankruptcy, and the bank having to get involved is minute. But who goes broke? Self-employed people. There's whole, accounting departments that deal with turnaround and insolvency for self-employed people. And the banks know this. They know that their percentage of risk increases with self-employed people, and that's why they just want to drill down and know everything about it. Because in their eyes, it's a riskier lend sometimes.
Yeah, and particularly we saw this over the last kind of 3 years with certain industries being targeted more so by the banks in terms of restrictions to lending. And that was, I can't remember all of them, but there was like airline self-employed individuals, builders, even certain kind of construction, but not really big construction like your commercial fit-outs. They were all restricted, weren't they?
Yeah, correct.
Thank you, COVID.
Thank you, COVID. And the latest ones that I've had where they question a little bit is the humble real estate agent. The humble real estate agent had their best year ever self-employed in 2021 rolling into 2022, and then interest rates went up and their market shrank a little bit. So, how does that affect their businesses? So,
and that's the thing, what we can see as common sense is in theory they're selling less, making less. Banks aren't above that. They also, even if they won't say that to us, they think it.
Correct. They're looking at industry trends.
And let's talk a little bit about the breakdown of the requirements under ASIC's kind of lending guidelines for self-employed applicants.
So there's a few different ways that self-employed people can evidence their income, right? So the simplest way that a handful of lenders do is if you are a proprietary limited company, you're the director of that company and you pay yourself a wage, and that wage is consistent, then just show us that wage for the last 6 months or 12 months and then that's your income. Yeah. Because that's a pretty pessimistic way to work out how to service debt, because obviously that wage is going to be a pretty low figure. Because if you're declaring it as a wage, you've got to pay super on it, tax on it, and self-employed people typically don't like to do that. So the bank then says, well, look, if they're prepared to pay that much super and that much tax on that wage, that must be the bare minimum of what this person earns.
Yeah.
So we'll consider that to be income. And if that income is enough to service the debt, we don't need to look at all the rest of the tax returns and the trust returns and everything else that's going on, which sometimes suits some self-employed people really well in terms of that kind of simple self-employed.
Well, like you said, I guess if they've been paying all of those additional things that come along with paying a PAYG wage to yourself as a director, your company would still have to be at some point turning a profit and meeting all of its commitments.
Correct. You can't draw a wage from a company that's not profitable.
No.
Or you shouldn't be anyway.
The accountant would slap you on the wrist, wouldn't they?
I was going to say, well, you shouldn't be.
No, you shouldn't be.
No, absolutely. And I know that the second tier is one that generally comes with a few higher interest rates and things like that, but it's still an option.
Yeah, so look, there is still for self-employed low doc options, or some lenders call them alt doc for alternative documentation. So you can't provide the normal tax returns that a bank is going to want to see over 2 years that are super consistent, that evidences your income. And this is typically when your business has a story. So let's say your business is less than 4 years old, you've been reinvesting heavily into growing your business and growing your turnover, and you're getting to a point where, maybe 6 months ago you backed that off and you started to make some serious cash, and you've saved up a deposit for a house and you want to buy or get into the market, but you don't actually have 2 good years worth of profitability. You've got a really good 6 months and you've got an accountant that knows where you're tracking, and you've got, the last 2 BASs show that you're making plenty of cash, but you want to use that to service the debt. So that information, along with a story, is what an alternative or a low doc lender is looking for. So,
and I don't think that those loans are long term either. Like
No.
once you do have the 2 years of returns that we can evidence, then we would pop you back over to a mainstream lender.
Kind of a more conforming lender.
Yeah. Correct.
Yeah, and there you can't just make up a figure out of the sky in terms of, this is going to be my income.
Yeah.
Like, it has to be supported by BAS statements, bank statements, accountants, declarations, that kind of thing.
Yeah.
But as Hope said, that this is what you do when you're getting into the market a little bit earlier than having 2 years full tax returns. But if you continued on like that, you would eventually have 2 years worth of tax returns, and then you can go back to a full doc
Happy
lender.
days, and then away we go.
Then it's back to the kind of the ideal path, if you will.
Yeah, correct.
And now the third option for self-employed applicants, which I'm going to say is 90% of the work that we do easily, that's the full verification method, isn't it?
Correct. Full verification method is the method that most people go down because it is the method that will enable you to borrow more than the other 2 methods. Okay, so if you're trying to buy an 80% loan to value ratio, or maybe even 90% loan to value ratio, you'll need a fully verified loan structure, right? So how that typically looks is the bank wants everything that's in the tree of money for you, right? They want to see it from the top and how it trickles all the way down to you. So this usually starts from the base of the tree. They want your personal tax returns and the notices of assessment showing that that's all up to date, and then they want to see where did you get the money from. So if you got the money from your family trust, then they want to see the tax returns for the family trust. If that family trust gets distributed to by your proprietary limited company and you also got a wage out of the proprietary limited company, then they want to see the tax returns for the proprietary limited company. That becomes in play. And then they'll want the financial statements for that business and also for the family trust, because that then shows all the liabilities that the company has and how the money kind of trickles down to you. When we give that level of detail, the bank, and we're giving it for 2 years, and financial statements contain 2 years worth of info, the bank is actually getting 3 years worth of information about your business, its turnover, its debts, its payroll, its outgoing commitments. It knows a lot about you and your business and how you work and operate.
It gives them a certain level of comfort to see, okay, well, for the last, I know it is only verifying in theory 2 years, but like David said, your previous year's financials will also have the back of another year in it still. So it kind of gives them 3 years to consider and say, yeah, this is reasonable.
It's like painting the most hectic story
Yes.
that we can supply.
That's correct. And sometimes, as you said, they come back and ask for extra bit of information, and that might be the interims for the current year or the BASs for the current year. That nearly gives a lender nearly a good 4 years worth of information about your business.
And look, as we're saying this, I know it will sound a little bit overwhelming, but really to highlight how regular this is, 90% again of our business easily goes through the full verification method because it is the most bang for buck.
Yeah, correct. You can borrow more under this method than any other method. It gives you better serviceability. It gives you access to better rates. And it gives you access to more lenders. So all lenders do this kind of lending. Well, almost all.
And the good thing is all of the banks that we work with do have those self-employed departments. So if this scenario is a little bit more complex, it's not like the bank's just going to turn it away.
No,
unless
no.
there's, a fair and just reason that it's not going to work.
I would say, though, that there are some lenders that manage self-employed people with a lot of different parts better than others. Like some of the smaller lenders don't have dedicated teams that are as experienced with people like that.
Yeah.
And sometimes those deals can just take a little bit longer to get approved because maybe that assessor's just not used to seeing trust tax returns and all those different things. But you're right, Jess, there are dedicated teams that look after them and they generally do a pretty good job.
Yeah, and as Hope's just touched on, there's lenders that do better than others, but, top of hand, there's, for example sake only, there's 3 lenders kind of mainstream that will look at 1-year tax returns. There's one lender that will look at an average of 2 years but doesn't really care about your business commitments as long as it's trading profitably. Then there's others that, will look at only an average of 2 years, use the lower of the 2 years. Some that'll look at the average, some that'll look at the higher with a 20% variance. Like, every bank is so different.
And they've all got what they've come up with as a responsible lending credit criteria.
Yeah.
And that's why I always say, get some advice or have a chat with a broker, because your specific set of circumstances might really appeal to one lender in particular.
Absolutely.
Rather than, and quite often I chat to self-employed people and I'm like, okay, well, why do we want to use this lender? And they're like, oh, I've banked with them for 10 years. And you're like, yes, but they don't have a product that suits or a credit criteria that suits you.
Yeah.
These 3 banks do.
And
they've all got their wee niches.
Yeah, and that's the hard thing, I think, is overcoming that kind of Dolomites, I like to call it, mindset where we've all had a bank account since we were 5 years old. But as you do get older, particularly for, like you've said, self-employed clients, unfortunately, shopping around can be the difference between you purchasing for $1 million or 1.2. Yes. Based on a 20% difference in lending.
Yep, absolutely. That can be the variance and is usually the variance on a daily basis between different lenders with different credit criteria.
Yeah, don't be loyal to one bank, guys. It's not in your best interest at all.
Yeah. No, and it's also, just never in your best interest to try and do something like this independently when you're self-employed. Talk to your accountant, see who they would recommend you chat to and get the ball rolling.
Correct.
Okay, now let's have a quick chat about what banks would kind of ideally like to see when it comes to someone who is self-employed, like the A-plus student.
I think the A-plus student, when we're taking their application to a lender, is that the bank just wants to see that they're super proactive and organised with their business admin.
Yeah.
So they just want to see, this person up to date with all tax returns. They want to see that it's trading profitably, hopefully.
Yeah.
Paying themselves a wage, low overall lease and debt commitments. They want to see also, hopefully, they're up to date with all their tax liabilities too.
Yeah, okay. So kind of just someone who is, like you said, on top of it, someone who's probably got an accountant that's hounding them every time they need to do something and they're doing it.
Yeah, absolutely. And I think that probably segues into the next thing, which is what not to show.
Yeah. And we know definitely what we don't like to see.
Yeah. So, things banks don't like to see is, and Hope kind of mentioned it before, is tax debts.
Yeah.
So get square with the ATO, know when your things are due and make sure that they're paid. And if you're just about to go for a loan application, actually make sure that you've got the money to pay the next tax debt.
Yeah.
So that's probably the number one. Number 2 is inconsistency. You're going to send your loan application with all of those supporting documents to someone who works in a credit department that doesn't know your business really well. And when they see, highs and lows in income or expenses or profitability, massively changing lease commitments and all that kind of thing, their natural instinct is to want to drill down on it. So just be consistent year on year. If you're going to make changes to your business, make slow changes that are thought out and methodical. Also, the other thing that banks kind of don't like, and this might seem really silly, is things that don't make sense. Right? So if you've then gone and paid yourself a wage, we were talking about this before, if you've gone and paid yourself a wage of $100,000 but your business has lost $20,000 for the year, or has a $20,000 loss, that doesn't make sense.
No.
Why are we doing this? If you've got a business that has a profitability of, $80,000 per year, but it's just leased, a $400,000 piece of equipment, that doesn't make sense either.
No.
So think about your business, and you're going to present it to someone who doesn't know your business, and does everything that you're doing make sense? If it doesn't, stop doing it.
Yeah, are you making good choices?
Yeah, and it's hard in that aspect because I know in terms of you often get this pigeonhole of I've got to do this to get the growth and I've got to do it now to get the growth now. But unfortunately, a bank just, it doesn't look that way to a bank. It looks like you're overcommitting yourself, doesn't it?
Yeah.
Correct. Yeah. And that's probably my last one, which is, you remember, we are going to send this to a bank that knows your industry, that has benchmarks and that is used to looking at businesses with turnovers that are somewhere in your vicinity. They know the looming issues. So I always say, have a chat to your broker, have a chat to your tax agent and know what looming issues you may have. Clients come to us all the time and they're like, I had an amazing year last year. And you're like, oh, cool. This is great. And they're like, I want to buy a house. I've got this amount of cash in the bank for the deposit. And you're like, okay, well, the next thing is you need to pay the tax on that.
Yeah.
And your provisional tax is going to change because now this is how profitable your business is. So this is, this is what your BASs are going to look like and this is what your, quarterly, tax statements are going to look like. And this is all due and needs to be paid out of the cash that you're going to use for the deposit on that house. So look at the looming issues. Look at what's going to happen in your business for the next 6 months because you can bet yourself that the bank is thinking in those terms.
Oh, absolutely. They like to forecast as best they can and think of the worst case scenario.
Yeah, correct.
And it's good that they do that because it is due diligence, isn't it?
It is, and you don't want someone borrowing more than what they should be either and putting themselves in a sticky situation.
Yeah, 100%. Now let's chat a little bit just to kind of tie us off here about, I know, David, you're self-employed. Hope you and I aren't. But anywho,
No, I'm not.
Let's all just chat a little bit about kind of your top tips for self-employed individuals. What would you like them to see? I know that we're only just into the new financial year now, but what ideally would you say to your clients to get a head start on things if they're even considering doing something in this financial year?
I think if they're considering doing something like buying a property or starting to grow their property, investment portfolio, whatever it may be, I think grab those drafts off your accountant and sit down with your broker or your lender and have a chat to them about what your future plans are and just start to get those plans in place moving forward. And then you can know where it's at, what money you might need just off the back of what Dave said.
Yep, to preserve
in order to achieve those goals, just all those types of things.
Yeah.
And I'd probably say housekeeping. So have a look at what's going on in your returns, have a look at what's going on in your business, have a look at what's going on in your personal life.
Yeah.
Quite often, we'll look at self-employed loan applications and we'll find 3 van loans for a plumber or electrician that are all due to end this year and replacements haven't been ordered. Well, the answer is, let's just get rid of those leases and then do the loan application because you've got commitments flowing out today that we don't have flowing out in 3 months' time. So, think about that from a lending perspective. Think about, do we need large credit card limits in the business or is it just something that we like to have? If not, let's get rid of them. Let's do the housekeeping and tidy up your statement of position in your business and also for you personally so it looks as clean and tidy to a bank as possible.
Yeah.
Yeah, and on the back of that, working in the compliance side myself, I think one thing that really does help a self-employed applicant, in the stages before they do apply is, like you said, housekeeping and tidying up the transacting between the business accounts and the personal accounts.
Yeah, that's a big one actually.
Like the banks will look at your personal credit card statement and they don't have the common sense that you and I will to say, oh, okay, this invoice for $1,500 to a plumber was probably related to your line of work because it's come from the personal account. So unfortunately, that's a regular expense that you pay as a person.
Yes.
So you've got to look at all of those kind of little macro level things that don't seem like a big deal to you. But once you look at 180 days worth of history, if you're spending $3,000 or $4,000 out of the personal accounts and reimbursing it, it still looks like you're spending $3,000 or $4,000 just for yourself.
Yeah, it does.
Yeah. So just once again, tidy up your accounts, tidy up your commitments, make sure that, everything is where it's meant to be. If you're paying direct debits for, internet or whatever that's meant to be in the company accounts, pay them out of the company account.
100%.
Right? Don't run it through your personal credit card to get points because you think that's awesome because it's going to cause you issues later on. I'd rather have a house than frequent flyer points, to be honest. So,
mate, you've got both. Let's be real.
So Dave's got the best of both worlds here.
So I'm 100% with you, Jess. Just tidy things up.
And just a side note, and I'm sure everyone listening's picked up on this, but I absolutely love how passionate you are about this, Dave.
Well, I look at self-employed people and tax returns, and it all tells a story, you know, and it's really kind of, I find it fun to work on.
Yeah, I can tell.
Jess and I get down with the spreadsheet and we work out, and we're adding back depreciation.
Oh, we love a spreadsheet.
Adding back interest and, you know, trying to work out the best deal for the client. And there's so much more to it than PAYG.
Yeah.
And I think that's why I like it.
Yeah.
And getting to know someone's actual story. Like, we can often look at a set of returns or financials and compare the 2 years, and you can see something's dropped off. And you instinctively know, okay, here's 3 scenarios that could have happened. Dave jumps on the phone and we're like, oh, okay, they were pregnant at that time. So, you know, the owner of the business took a few months off, turnover dropped. But this year, kids in childcare, you're back at work, it's all back again. And without looking at those numbers with experience to know, a bank just wouldn't even know what to do.
Well, Jess and I had one not so long ago that they owned a couple of service stations, and we could see that there was something in the returns really weird for a period. The turnover had dropped, but the cost had dropped, but there was incentives that had come from somewhere else.
Yeah.
And the bank was looking at it going, there's something here.
It's
We
fishy.
were looking at it going, there's something here. Anyway, we rang the client and just explained what we had seen, and it turns out that the service station was on a major road and there was roadworks happening.
Oh, wow.
And it decreased the flow of traffic into the service station. That decreased how much they were selling, but because they were selling less, they had less staff. And that because they had less staff, they had less cleaning. And then, the
flow-on effect.
The flow-on effect. And you could see that there was something there, but you just weren't sure. And I think that's where, once we put the story to it, the lender was super happy with it.
Yeah, because that makes sense.
Yeah, because it made sense. And they're not going to build a road for the next 50 years.
No.
Like, it was a snapshot in time. It affected the business, and the lender was able just to put a line through it and just go, yeah, okay, well, we're just not going to look at that bit. We'll look at the other bits that are normal.
Yeah.
And the funny thing about that instance is this client actually had a business banker who had already looked at it and said no.
Yeah.
So again, the power of shopping around and using someone who has the ability to talk to a few dozen people and see who wants it. Like that deal, those clients wouldn't have been able to settle on a purchase they'd committed to without our intervention. And it sounds very egotistical for us to say that, but it's just the fact of the matter.
Yeah. But it's the power of the wealth of knowledge that David Thomas presents.
Yeah. Davey T's tidbits.
Yeah.
Perfect.
Okay, well, thank you everyone who joined us today while we did run through this kind of self-employed section. As always, if you've got any questions at all, you need to run a scenario by anyone at Team Trilogy, feel free to get in touch via our website, which is trilogyfunding, all one word, .com.au. You can inquire within that website and book in a time to chat with anyone, or simply ask for a call back. To be honest, Sophie is always happy to have a chat. I know that Dave, Hope, Nicole and Paul always are. You may even hear from myself or Carrie. But yeah, if you do have any questions at all, get in touch. Otherwise, thank you very much for tuning in.
All right. Thanks, Jess.
Thanks
so much,
guys.
We acknowledge the traditional owners and custodians of the land this podcast is being recorded, the Ngunnawal people. We pay our respects to the elders of the Ngunnawal people, both past and present.